So we're going to talk about something that is going to change drastically on July 1st. So federal government starts this new student loan repayment system to unwind and reopening a new repayment plan. So a lot of loan officers are missing this. The plan they pick changes the monthly payment for the credit report, and that payment flows into the DTI qualifications. So what we need to do is to overcome this by providing multiple options with either refinance that can cut homeowners' rate significantly by paying off the student loan using the equity, or using the home buyer to qualify with a higher loan amount by understanding how to navigate this properly. So let's dive into it. So here's why and I want you to care about this. According to statistics, roughly 43 million people carry federal student loans, and a huge share are buyers, the late 20s to 40s with decent income who's scared with debt will sink their approval. So starting in 2 weeks, the servicer will mail out a notice stating your plan will change, pick a new one. Most people just click and choose whatever the easiest, but that choice sets their monthly payment, and that payment is going to be the biggest lever in their DTI. So notice the two plays on this slide. One is a purchase. We help a buyer qualify for more home. Play two is a refinance. We play and help the existing homeowner to cut their rate by paying off the student loan the smart way. That's the $159 per month example that we'll build later. One change in the law, the two ways for us to win. So let's take a look. So what we're going to go over today, this is a quick roadmap. I divided into 5 parts. One, what actually changes July 1st? This save goes away, and this new income payment coming in, and who will get impacted. And 2, the part where that talks about the payment, how each plan moves the DTI, and which loan type we need to choose, and what determines the percentage to hit the debt to income ratio. And 3, the 3 client stories that I brought up today, so that you can see how the right answer flips by income and the timeline. And the 4, the refinance play, in case we talk to the homeowners directly, how paying off a student loan through a refinance can reduce their pricing and payment, and rate and term definition, and the cash out definition, so that we understand clearly how to help the client's money. And the 5, how we actually advise the talk trace checklist and how to turn all these into a file. So part 1. So background, this tied all into 2024. And our experiences, this, servicer changes, but then they never fully launched with a student loan waiver. So the new payment plan has been coming up. So within 90 days, if they don't choose it, they will be auto-enrolled into the standard plan, which usually has the highest monthly payment plan. And worst outcome is all the pre-qualification that we were doing will automatically be denied. So there are 3 things we need to know. 1, the repayment assistance plan, the new income-driven plan, is going to roll out. 1 to 10% of the income, an interest waiver, so the balance won't grow as they pay. Forgiveness at 30 years. And the tier standard, a fixed payment plan for the 10 to 25 years. And this is what people usually get dumped into if they don't choose anything. And the 3rd is the older income-based plan. So these will come up through at least July 2028, and it can document to a 0 payment. So we will show a matter a lot. So with the IBR plan, we're going to go in depth about this and how to itemize and how to understand the debt to income calculation. The whole plan on the bottom line is to match the plan to the person before the selection is chosen, and for the transaction to save, purchase, and the refinance transactions. So I'm going to brush off very briefly about how the calculation works. So this RAP is based on the adjusted gross income, and apply the percentage and divide it by 12. So depending on the income, the percentages turn from $10 all the way to the 10%. And if you read the table, $65,000 income, then it's the 6% bracket. So what we need to know is this plan will work very well for the lower and moderate income individuals, anyone who's applying for the first time home buyer product, and this climbs really fast. So if the individuals have a 6-figure income, then it is sometimes better to just plug them into the standard plan. And second, so this fixed payment plan is based on the balance and spread over the 10 to 25 years term. It doesn't move with income. Good thing about it is it's usually fixed and showing on the credit report. What we've been seeing in the last a couple of months was clients who already had this plan show a higher monthly payment on the credit report. So we had a client who were making $230, $245 a month, now seeing almost $900 to $1,000 per month showing on the credit report. So we have to go back and readjust the payment plan. So in this case, this is an auto-enroll default product. So whenever you consult with a buyer and when they mention about the student loan, make sure you mention about this before you pull the credit so that we have a proper expectation. And even if they pull the credit with different payment plan, we can always do the rapid rescore and update the information on the credit report. And this is the one that we still can apply. So if anyone trying to buy today, within today and July 2028, and this income-based repayment can be a goal. So even though it shows a zero payment, we can use this percentage calculation and apply for the conventional loans. And after July 2028, anyone sitting on this IBR payment who hasn't chosen to get auto moved into RAP. So is existing IBR borrowers who's buying soon right now, what we usually say is don't touch it. Don't call them, don't bother them, just take it and ride with it until we close the transaction. Someone who's thinking of buying after 2028, then we have to give them some options to choose. And there are some of us, working with a first-time home buyer for the last 6 to 8 months, all the way to a year. So this documented zero payment on the IBR can be a powerful card to a borrower to either motivate them to make a decision today or to plan out accordingly for the next years to come. So this is the problem. This is a trap. If your borrower takes out any new federal loan on or after July 1st, even with a pile of older loans before, all their federal loans must follow the new rules. So new loan rewrites the rule book for the whole balance. So where it bites is going back to the school for the certificate years ago, consolidating loan in a one way to constitute new borrowing. Suddenly, this IBR payment option their counting is turning off. So their new RAP rules apply on this new payment. So this is going to drastically kill the DTI. So when we address questions to each and every student, conversations, we need to ask: are we planning any new federal loans? Are we going back to the school, or are we going to consolidate before we close? If the answer is yes, then we talk timing before they touch anything. So this play will come in play when you talk to the FAFSA student loan advisors and the brokers. We must address this. New plan will drastically increase the debt to income ratio. And part 2, let's talk about how it hits the mortgage and the qualification. So when we talk about the debt to income ratio, we always talk about 45% DTI rule. This 45% came from Fannie Mae's cash out and Freddie Mac's cash out. So Freddie Mac, DTI above 45 is not going to pass. But with Fannie Mae, by providing 6 months of reserves, we were able to qualify the loan. Now, FHA can go up with a higher compensating factor, going up to 56.9%. But one thing that I want to make sure and emphasize is the student loan payment that sits inside this ratio. So lowering the documented payment frees up the room. So every dollar of the student loan payment we remove is going to be $1 on the housing payment the borrower can borrow and afford. So the lever on the purchase, as you see, is the lever on the refinance as well. Same rules apply, okay? So now the rule that decides the number actually goes in. When we see zero payment on the credit report, that doesn't mean that it is a zero of debt. Zero payment is not a zero debt to us, a lender. And the credit report shows a zero or deferred. Most lenders don't use zero. They substitute 0.5% for the Freddie Mac, 1% for the Fannie Mae. And about $60,000 loan balance, we talk about $300 a month for the Freddie Mac, $600 for the Fannie Mae. even at a real 0% $0 payment. So let's talk about this. Same borrower, same zero payment, two different answers by which product we choose. So this is where a good loan officer makes real money for the client. So on the conventional, backed by Fannie Mae, we use a documented income-driven payment as reported, showing zero, real documented zero. But FHA, it is less forgiving. FHA uses a documented payment, but if it's zero or deferred, it reverts to 0.5%. So the same borrower case, 300 a month, a phantom of that on FHA doesn't exist on the conventional. Again, this income-driven repayment plan is a gold with conventional, not so much with a government loan. So in this case, even though conventional rates are higher, we can lead the client to choose the conventional loan product to qualify higher loan amount. So I don't want you to eyeball it. I don't want you to skip through. Even though it's the same borrower with a $60,000 debt with no dependent, depending on how we plug this client in, the answers can change. So on the RAP or the IBR payment option, we're talking about $200. But for the FHA and VA, the Gavi loans, 0.5% rules apply. And for the tiered standard, this is where the scary thing is. It starts at $650, which is greater than 1% rule from Fannie Mae. So collect the documented payment, pull the credit report, and compare with a 0.5% default rule. And whichever one is lower will be used for the calculation. So I'm going to bring in and share the 3 client stories. So story 1 is a lower income applicant with a $50,000 annual income, $55,000 student loan, first-time home buyer who's very nervous about the debt. So this best move will be RAP because of an income, monthly payment is significantly lower than other options. And the second story is with a moderate income with $110,000 annual income with same student loan balance at $55,000. Best will be the standard or IBR, not the RAP because of the income cap. And third, the existing IBR clients whom we meet the most right now with a documented zero, with a $45,000 student loan, and who's willing to buy the home before the 2028. So on the conventional, we have the documented zero will be counted as a zero on the TTI calculation. So let's go deferred. Then deferred will be using different percentage in the RAP because of the income cap has a higher payment option as well. So understanding this student loan type will also lead into another win. So you may wonder if you are talking to the referral partners, CPAs, insurance firms, they usually refer us to or recommend to bring down the monthly payment. The reason is two. When the student loan payment is reduced, these individuals will more than likely to sign up for another insurance policy. It could be, a term or IUL, whatever the policy they will write. Now, because their monthly payment has been simplified, these agencies, insurance firms, have a chance to sell another product. That's why mortgage industry, mortgage loan officers can also plug in and play together. This is my favorite, by the way. And by far, we've been helping a lot of buyers to qualify, understanding which platform to pick, which product to give. So by lowering the payment, paying off the student loan through refinance is going to open up another pipelines. Let's talk about this program. Let's talk about this mechanism. Normally, when a borrower pulls the cash out of their home to pay off any debt, it is considered as a cash out refinance. Cash out refinances carry pricing add-ons, whether it's for Fannie, Freddie, they call it LLPAs, loan level price adjustments, and those push up the rate. But Fannie Mae also has a specific program, student loan cash out refinance. So if the cash is used to pay off a student loan and you meet the requirements, the loan is priced as a limited cash out, basically a rate and term pricing. So expensive cash out add-ons is waived. Behind the scene, it is delivered to special feature, and you don't need to memorize everything just to know the real, the mechanism, so that you apply when you hear the student loan will be paid off throughout the process. The result is roughly a quarter to half point lower in a rate. So when you price out the loan, you'll be significantly, you're going to see a loan amount of $100,000, approximate of 1,375 will change. So same borrower, $800,000 value with a 640 loan amount with 760 FICO scores. So we don't have to talk about LLPA hit too much compared to an applicant who has a 700 credit scores. Even though this person has an A+ FICO scores at 760, with a rate and term will be at 6.5, regular standard cash out at 6.875. So by plugging in the right product, we are helping the borrowers to save $159 a month, approximately about $1,908 a year. So the rule is how to qualify, how to apply, to execute. We need to apply these 3 requirement rules. 1, at least one student loan must be paid off in full. No partial payoffs are allowed, and the money goes directly to the servicer at closing through escrow and attorney offices. 2, at least one borrower on the mortgage has to actually owe the student loan. 3, it is underwritten as DU, so this is a nuance. The cash out LTV limits apply for the eligibility, but the pricing is better for the limited cash out pricing. So what do you mean? LTV at cash out caps at 80. So we need to run the pricing at limited cash out LTV under 80%. So you must say this to every client. If a student loan you're paying off is a federal loan, you are converting federal debt into a mortgage debt, and that means they give up income-driven repayment, forbearances, and forgiveness forever. So this play is the best for the borrower with private or high-rate student loans, or people who genuinely don't need the federal safety net. For some, relying on the documented zero payment or chasing forgiveness after the 30th year, this is a wrong move. Match the tool to the person. And especially for those working for the counties and cities who has a 10-year forgivable plan, also mention about this plan is not the best for them as well. So let's talk about the checklist. Before July 1st, what we need to deliver, what kind of warnings, what kind of information that we need to deliver so that we generate files from all of these. So this is a playbook that I want to share today. 5 things before July 1st. 1 is to confirm the current plan. They can go to studentaid.gov and know the plan and the payment. So we are using credit report as an indicating factor, but ask the borrower to go into studentaid.gov and then capture the payment option that they are having at this time. And second, run the 0.5% rule test. The reason why I don't talk about the 1% right now is we can always go to the Freddie Mac or FHA or VA. Balance times 0.5%. That's the phantom payment, even if it shows a 0. 3, match the plan to the loan type. Documented low or 0 IDR usually does better on conventional than FHA. And 4, screenplay this refinance into a chart. If they've got a private or high rate student loan and equity in the home, create the payment plan for the rate and term payoff and show how much money they're saving each month in a year. 5, pre-approve before they switch the plan. So what we need to do is lock in the current payment with the documentation ahead before the transaction starts. So a lot of us may get into this, issues by not pulling the hard pull credit before we issue pre-approval letter. A lot of us still pull soft pull credit reports for pre-qualification and pre-approval. So after July 1st, if you hear student loan, do not allow yourself to pull soft pull credit report. If you make a simple mistake with detailed calculation, that will waste the borrower and the real estate agent's time and energy. And they will also lose the relationship and the opportunity. So the actual words, you don't have to be a student loan expert. You don't have to start the right conversation. When you write things down, when you post it on the YouTube, Instagram, and online presence, they will look at your content and they will walk into you. Open with a letter. You are about to get a letter telling you to pick a new student loan plan. Before you pick anything, before you click anything, let's talk. It affects how much home you qualify for and educate them. Simply, a $0 payment doesn't always count as 0. Something like some loans add 0.5% of the balance as a phantom debt, and we can often avoid that before it comes up. So now we add a third thing in there. What kind of offer can we provide? If you got student loans and some equity for the homeowners, there may be a way to pay them off and lower the rate at the same time. So a lot of homeowners who are sitting with 3 and 4% rates can be drastically save a lot of money, monthly payments, by understanding the product. So all we need to do is open up our calendar, educate them, and offer. But this third line is what I want to emphasize for all the refinance files as well, along with any homeowners who's willing to reduce their current payment to qualify for the next home, second or the third home. So one warning that I want to provide today is to the borrowers who think that they will just refinance the federal loan into lower payment. That can be a private student lender or a unsecured loans, but it can be our mortgage payoff. Either way, the total loan balance will grow. We're just reallocating where and how. So if this strips the federal status of the loan, it's a permanent, and it kills 3 things: income-driven repayment, federal forbearance, and forgiveness. This connects directly back into refinance play. So although it is very powerful, it only fits to the borrower who doesn't need the federal protection, private or high-rate loans, or someone who isn't chasing forgiveness. The rule we give to the client is talk to them first, discovery call with findings, and then we advise who protects them here and not to the one who lets them blow up their own flexibility. A lot of complaints will come into the play if you don't properly guide them what they're getting and what they're losing. So 4 things you need to memorize today. Lock them in. 1 is the zero payment is not zero debt. Many lenders add 0.5% to the balance as a phantom debt. 2, conventional often wins. Fannie Mae counts, Freddie Mac counts as a documented zero. However, FHA, VA, USDA reverts to 0.5%. 3, universal best plan. There is no universal best plan. RAP for the lower income, standard and IBR for the upper class. So run the numbers. And the last, apply this refi play, paying off a student loan at a rate and term. At a rate and term pricing instead of a cash out is saving hundreds of dollars with an example chart. So these 4 ideas will turn confusing misleading information into an advantage for us, to the client, and for the opportunities that we can open up. So I want all of us to start our Instagram and YouTube page and start posting content, educating homeowners what is coming up, what millions of buyers are getting a confusing letter. When they have no idea who to talk to, I want them to call one of us and start the conversation. We want to be the people who explain it first. So 3 steps. 1, post it, get on social, LinkedIn, Instagram, and wherever your people are, and teach them the zero is not zero rule and the refinance play. Teach, don't sell. Educational content wins at this time is what gets shared and remembered. And 2, help people offer a free 15-minute plan review before July 1st and actually run their numbers, be useful for free. And 3, earn the file. When you lead with value, application will follow. Purchase qualification refinance with the homeowners, realtors, 1 good post can become 1 file. And starting July, these mathematical repeating posts over and over again will help you to lead another conversation. That's how we turn a law change into our pipeline.